Hey everyone, welcome back to the Investing Guideline. I have to be honest, the more I look at this week, the less worried I am. And I know that sounds strange, because if you only looked at the headlines, this week looks scary. AI stocks sold off, Nvidia had a rough week, semiconductors were under pressure, oil moved lower, but the Iran situation is still not fully solved. And investors are still trying to understand what the new Fed chair means for the market. So yes, it looks like there are risks. But when I look underneath the surface this week, I didn't see a market that is completely breaking. I saw something different. I saw a market rotating. I saw companies making long-term bets. I saw insiders buying weakness. And I saw investors are confusing correction with something much bigger. So let's go through what actually happened. I want to start with one of the most interesting story of the week, and that is Fiserv. So Fiserv dropped after its CEO suddenly left the company to become the new head of Truist Securities. So when a CEO leaves suddenly, especially after the stock has already been under pressure, investors usually panic. And honestly, I understand why. Leadership changes create uncertainty, and the market hates uncertainty. But here is the part that caught my attention. After the drop, several Fiserv insiders bought stock. The CFO, Paul Todd, bought around 10,000 shares. The chief legal officer also bought roughly $500,000 worth of stock. And several board members bought shares as well. Now, this is where I think investors need to slow down and understand something. Insider selling is not always bearish. Executives sell stocks for many reasons. The reason can be taxes, diversification, personal liquidity, estate planning. But insider buying is different, because insiders usually buy for one main reason. They believe the stock is worth owning at that price. So does that mean Fiserv has to go higher immediately? No, of course not. But when a stock is hated, the CEO leaves, the chart looks ugly, and insiders still step in and buy with their own money. I think that deserves attention. It's not because it's guaranteed trade, but because it shows you something about behavior. And in markets, behavior tells you more than headlines. Now you keep that in mind, because the second story of this week is also about behavior. While everyone was watching AI stocks, pharma companies were quietly spending billions. AbbVie announced that it will acquire Apogee Therapeutics for around $10.9 billion. That is definitely not a small deal. And earlier this month, GSK agreed to acquire Nuvalent for around $10.6 billion. So while retail investors are arguing about whether Nvidia is too expensive, large pharmaceutical companies are writing $10 billion checks. And this matters because acquisitions are not random. When a big company buys another company, especially at a premium, it's making a statement. It is basically saying we believe this asset is more valuable in our hands than the market currently understands. That is corporate capital allocation. And this is something I think many retail investors ignore. They focus only on stock price, but big companies focus on pipelines, future revenue, patents, drug approvals, and long-term market opportunity. So when I see multiple large biotech acquisitions, I don't just see mergers and acquisitions news. I see large companies trying to buy future growth. And that tells me something important. There is still risk appetite in the market. Maybe not in every AI stocks, but capital is still moving. And that brings me to Micron. Micron reported very strong results this week. The stock initially jumped because of the company showed strong demand, especially connected to AI data centers and memory. But then something interesting happened. After the first reaction, memory and chip stocks started selling off again. Micron pulled back, Nvidia pulled back. Other semiconductor names also came under pressure. And this is where I think the market gets complicated. Because Micron is not just about Micron. Micron is one of the cleanest reads on AI infrastructure demand. When companies build AI data centers, they don't only need GPUs. They need memory, they need storage, they need power, they need networking. So when Micron says demand is strong, I don't hear only Micron had good earnings. I hear AI infrastructure spending is still alive. But at the same time, the market is also starting to ask a very important question. At what price? Because if memory costs are rising too much, that may be good for Micron, but it can create pressure somewhere else. It can hurt margins. It can increase product prices. It can make investors question whether the AI build-out is becoming too expensive. And I think that is why the market reaction was so mixed. The earnings were strong. Demand story is real. But the stock was already up a lot. And when a stock is up that much, good news is not always enough. I think this is a very important lesson. A good company is not always a good entry. A strong earnings report is not always a buy signal. And a pullback after good news doesn't always mean the story is broken. Sometimes it just means expectations were too high. And now this connects perfectly with another deal from this week. Onsemi buying Synaptics. Onsemi announced a $7 billion all-stock deal to acquire Synaptics. The idea is to expand into what they call physical AI. Things like robotics, autonomous systems, smart devices, and edge AI. On paper, that sounds very exciting. AI moving from data centers into the real world. But the stock sold off hard after the announcement. And this is exactly why I think this week was so interesting. The market is not blindly rewarding every AI headline anymore. A few months ago, maybe any company saying AI would get rewarded. crowded. But now investors are asking better questions. Is the deal worth it? Does it distract management? Is this really the right strategy? And that is not necessarily bearish. Actually, I think it may be healthy because strong markets need discipline. If every AI headlines pumps, that's dangerous. But if the market starts separating real opportunity from questionable execution, that is much healthier environment. And this is actually why I'm not convinced that this week was some major warning signal. To me, it looked more like investors becoming selective, and that's why I feel fine with this. Now let's talk about the macro side. Oil moved lower this week as more tanker traffic started leaving the Strait of Hormuz and some supply fears eased. That is important because oil is not just oil. Oil affects inflation expectations. Inflation expectations affect interest rates. Interest rates affect valuations, and valuations affect growth stocks. So when oil cools down, that can reduce pressure on the market. But here is the problem. The geopolitical risk is not gone. The Iran situation is still fragile, and there are still risks around shipping, supply routes, and future escalation. So I wouldn't say oil falling means everything is fine. But I would say this. The market is no longer pricing the worst case scenario. And that matters because markets don't need perfect news to move higher. They just need the worst case scenario to become less likely. And now the final piece is the Fed. This is the first period where markets are dealing with Kevin Warsh as the new Fed chair. And I think investors are still trying to understand him. They are questioning, is he going to be more hawkish? Will he protect inflation credibility? Will he respond to political pressure? Will he support liquidity if the market gets unstable? These questions matter because the Fed is not just about interest rates. The Fed directly affects liquidity, and liquidity directly affects risk assets. So this is why I don't look at the current pullbacks and immediately think this is crash. For me to call something a crash, I need to see more than red candles. I need to see credit stress, liquidity problems, earnings drop, a real change in economic expectations. Right now, I don't think the evidence is strong enough. What I see is a market that ran very hard, especially in AI and semiconductors. Then investors start taking profits. Some crowded trades cooled down, some capital rotated into other areas, and suddenly everyone wants to call it a bubble. Maybe I am wrong, but I don't see it that way. I think this may be exactly what the market needed. A reset, a shakeout, a reminder that stocks don't move in straight lines. And honestly, I would rather see a market correction and become selective than see everything go vertical for no reason. So here is my main takeaway from this week. I'm not ignoring the risks. AI valuations are still high. Geopolitical risk is still real. The Fed is still important. And some stocks have moved way too far, way too fast. But underneath the surface, I still see capital moving. Insiders are buying weakness in some beaten down names. Pharma companies are buying future growth. AI infrastructure demand still looks strong. And the market is becoming more selective instead of completely falling apart. That is why the more I look at this week, the less worried I am. Not because everything is bullish, but because this looks more like a correction than a collapse. And for investors, that difference matters a lot. Because if you treat every correction like a threat, you will always be scared out of opportunity. But if you treat every crash like a correction, you can get destroyed. The skill is knowing the difference. And right now, I don't think this market is giving us a clear crash signal. I think it's telling us to be more selective. And that is my view after this week. Let me know what you think. Do you think this is just a healthy correction, or do you think something bigger is starting? If you enjoyed this breakdowns, let me know in the comment section. Don't forget to like this video and subscribe to my channel. I will see you in the next one.